Good morning dear learners and welcome to you all in the 7th module of my course on financial literacy. This is lecture number 31, investment in mutual fund and in SIPs. In the previous 6 modules, we have learned about the basics of personal finance and we had also discussed the various investment avenues in the securities market and in the money market instruments. Now, in the further discussions, we will be going to learn what are the other different financial products and financial instruments in which we can invest our money and we can also manage the risk associated with the investments, and we can also have some constant and regular return for our investment. So, those investors who are having small savings with them, they can also invest into the financial system of our country and they can also fulfill their long term objective of being financially secure in future. So, there are multiple kind of financial instruments such as the mutual fund, insurance products, systematic investment plans that we will be going to discuss in our these different modules and lectures that will help you to decide which investment avenue is better and may be relevant with the your financial objective. So, I Dr. Vandana Sonkar welcome you all to this lecture where we will be going to discuss the mutual fund and the SIPs. So, in this lecture we will be going to cover the conceptual parts related with the mutual funds and its various advantages that an investor may have. We will be also going to discuss how the SIPs work, how it can help you to make your investment into the different financial instruments and diversify the risk associated with the equities or debt instrument. If we directly invest in those instruments, then we will have to face a larger amount of risk, whereas with the help of SIPs, we can very easily diversify the risk associated in all these financial instruments. We will be also going to discuss the difference between the SIPs and lump sum investment, and we will be going to understand what are the different types of SIPs that are available into the market and what are its advantages. So, let us discuss the first concept, that is the mutual fund. Basically, mutual fund is a type of financial instrument in which the different investors with the help of their small pool of saving can invest into a diversified portfolio and they can minimize the risk associated with their investment. So, here we can see that there are number of investors in the market who are having a small amount of savings with them. They pool their money together to create a large amount of fund, and this fund is given to the fund manager who may be the expert in the financial market, and they must be having the knowledge and experience related with the investment, and they also may have some experience and updates related with the financial markets and system. They choose the various securities in which they want to invest your money depending on the risk management aspect. So, they diversify the risk associated with the investment with the help of diversifying your total amount of investment into different type of financial instrument such as equity, debt and other type of financial instruments. So, they very easily manage your risk and invest your money into different type of financial security. With the help of diversifying and managing the risk, they assure you some regular return with the help of which you can increase your wealth and you can accumulate your wealth that comes to you in the form of return, and this is then passed down to the investor. So, this is how the mutual fund system works. So, mutual fund can be defined as an investment vehicle or financial instrument that aims at pooling the small amount of savings from different investors of the market and investing the money into a varied portfolio of securities from the financial market. In India, the first mutual fund was introduced in the year 1964 by the Unit Trust of India, and the Unit Trust of India was the first one who started started mutual fund. Later, some of the other commercial banks such as SBI has also started to offer the different mutual fund investments to their investors. So in India, the UTI was established in the similar line of the operation that was based in the UK as the investment trust companies. So in mutual fund, the multiple categories of investors who may have different amounts of savings with them, they come together and they give their money to a managing professional who manage all the fund into different financial instrument. They invest it into the different financial instrument with the help of their financial expertise and their knowledge related with the financial instrument and financial market. So they manage the risk for you and they assure you some guaranteed returns. Mutual fund, according to the mutual fund book published by Investment Company Institute of the US, have been defined as a financial service organization that receives money from various shareholders. They invest it into the diversified portfolio and earns return on it and attempt to make it grow and agrees to pay the shareholders cash on demand for the current value of his or her investment. So they aim at collecting a small amount of savings from variety of investors, and they aim at minimizing the risk by diversifying the portfolio and giving some assured sum of money to their investors as and when desired by them. According to the Security Exchange Board of India mutual fund regulation that was amended in the year 1996 and again in the year 2008, mutual fund has been defined as a fund that is established in the form of trust to raise money through the sale of units to the public or a section of the public under one or more scheme for investing into different type of securities, including the money market instrument or gold or real estate. That means it is an organization that aims at pooling the investments from different sections of the society. That means the middle income level society, the higher level income society or the lower level income of society, all of the investors can invest their money into the mutual fund schemes, and then this money is invested into the different type of financial securities such as debt, equity, money market instrument or some assured and guaranteed return assets such as gold or real estate. In this type of investment avenues are also your money is invested by the mutual fund organization. So this is the meaning of the mutual fund that have been explained according to the Security Exchange Board of India Mutual Fund Regulation 2008 and 1996. Now, let us understand what are the different advantages of investing into the mutual fund. If we talk about the aspects of the significance, what different significant the mutual fund investment schemes are having in comparison to the other investment avenues in the market, then certainly it is going to give you wealth accumulation with flexible investment. In the long term investment securities that we had discussed in the module number 6, we had discussed that there is a high risk involvement in the equity or in the debt securities in the financial market, whereas money market instrument offers you guaranteed return, but those returns may not be higher as compared to the security market financial instrument. But in case of the mutual fund, your portfolio is diversified, the investments are made into equity as well as into debt, money market instrument and different other categories of the investment avenues, so as to give you guaranteed as well as higher amount of return. So with the help of flexible investment, mutual fund schemes aims at wealth accumulation for the investor. Next is, it also helps you with the professional management and the oversight. So the different sections of society such as higher level income group, middle level income group or lower level income group, they may not be having expertise in the financial market. They may not be aware of all the different factors that may affect their investment decisions. So in such cases, when they do not have enough of information or enough of expertise in the field, they are guided with the help of professional management and oversight in the mutual fund schemes. So, the investment decision in the mutual fund schemes are taken by some professional investors after analyzing the different financial instrument in the market, take the decision of investing your fund into the different investment avenues. So, here without giving a lot of time into the research and other type of activities, evaluation of the different investment avenues, you can easily invest your money into diversified portfolio with the help of the professional guidance. After that, the next advantage that an investor may have of the mutual fund is the diversification. That means your money that you will be going to invest with the help of mutual fund will be diversified into different type of financial instrument. So, here you need not to take the information or to take the individual decision of investing your money in parts in different type of financial securities. You can only invest into one scheme and your total of the money will be divided into different type of financial securities. So, your money will be invested into the equities, your money will be invested into debts as well as gold or real estate or FDs. So, different type of investment avenues will be taken or included into the mutual fund scheme for the purpose of minimizing the risk invested into the investment scheme as well as for maximizing the returns for the investors. Next is higher liquidity. So, this kind of investment schemes also offers you a great extent of liquidity, as there is a option that whenever you are in need, you can withdraw your money from the mutual fund schemes. So, with the help of the concept of the net asset value of your investment at a particular point of time, your money can be also given you back whenever you are in need. So, higher liquidity is there, your money can be invested for a longer period of time as well as for a shorter time period depending on your investment objective. Next is the tax benefit. Mutual funds are also helpful for the investors for having different kind of tax benefits, as there are multiple type of mutual fund schemes that may be helpful for you to claim multiple deduction under section 80C of the Income Tax Act 1961. So, if you want to minimize your tax burden and manage your taxes, then also you can take the help of mutual fund schemes. You can invest your money into these schemes and you can minimize your tax burden with the help of deducting your total taxable income by investing into the mutual fund schemes. Then low transactions cost are involved in the case of mutual fund schemes. In case of the other financial securities, when you invest into the security market or in money market, the operational cost may be higher, as whenever you invest into one particular kind of investment avenue, you need to take the help of multiple platforms and brokers for the purpose of investment, whereas here at once you will get the professional guidance and help of the professional manager for the purpose of investing into different and varied schemes of the investments that are available into different type of security market, money market or the other type of investment avenues. So, transaction cost is also lower as compared to the other investment avenues. After that, safety and systematic investment. Here mutual fund managers, the trust, it offers you one more advantage of safety and systematic investment. In a small amount of contribution, you can invest into the mutual fund schemes. You can also have great amount of security of your money by the professional management of the scheme manager, who will be going to analyze all the risk associated with the financial investment, and they will also guide you with the different other aspects related with the mutual fund investment. So, here systematic investment plan is created for every investor, and safety is also taken care of by the professional manager of the mutual fund schemes. So these are the different advantages of the mutual fund schemes. Now let us discuss the next part, that is the types of mutual fund based on the investment objective. So mutual funds can be categorized into different types based on the purpose of investment. That means what the investor aims to achieve by investing their money into the financial system of the country. So some of the investor may have an objective of growth of their wealth. That means they may aim at wealth accumulation, whereas some of the investor may have an objective of earning a stable and regular income from the investment. So mainly having a stable source of income may be the objective of the investor. Some of the investor may have an objective of ensuring the liquidity of their invested fund. That means they want to invest their money in such investment avenues from where they can take their investment back whenever they are in need. And some of the investor may have the purpose of saving the tax that they need to pay in a financial year after calculating their total taxable income. So these may be the different objectives of the different category of investors in the financial market, and on the basis of all these objectives, different categories of mutual funds are available here. So basically there is first one, that is known as the equity mutual fund or growth oriented fund, that offers you wealth accumulation. That means the objective of such type of the mutual fund scheme is to appreciate the total amount of fund invested by the investor over a long term period. So predominantly they invest your money into the equity or shares of the listed company into the different recognized stock exchanges. In such kind of the mutual fund schemes, the risk is comparatively higher as compared to the other schemes, whereas long term wealth creation can be done very easily with the help of the growth oriented schemes. Here you can aim at retirement planning, financial independence over a period of time, and the wealth accumulation can also be done with the help of such type of schemes. So here some subtypes of the mutual fund schemes are also available, such as large cap funds are there. These large cap funds invest your money into top 100 companies of the country, those who are having a stable financial performance and their financial instruments are less riskier to invest the money into the market. Then there is mid cap and small cap funds. For the purpose of higher growth potential and higher risk, you can invest into the higher mid cap and small cap funds, whereas there are multi cap and flexi cap funds where diversified portfolio is taken into consideration across the different market caps, and there is sector and thematic fund that focuses on the specific sectors of the economy such as pharmaceuticals or IT. Now the next category of the fund is the debt mutual fund. These debt mutual fund helps an investor to have a stable and regular source of income over a period of time. So basically these are income oriented fund, and the objective of such kind of these schemes is to generate the regular income with capital preservation for the investors of the scheme. So here they invest your money into the bonds, debentures, government securities, those who guarantee you some stable and regular return, and money market instrument. So here the risk level is lower as compared to the growth oriented fund, and it is suitable basically for the short to medium term investors of the market who are having low risk appetite. So for those investors who want to invest their money for a short term period or a medium term period and want to have a suitable amount of risk, that means moderate amount of risk, for them debt mutual fund can be a good option. So here the subtypes of the mutual fund schemes are liquidity funds that offer a very short term period investment to the investor, say only for 1 day to the 91 days. Then short duration fund are there that is having a 1 to 3 years of time horizon. Then gilt funds are there that invest the money into the government securities, that means the public sector unit securities. So the investment will be always safe as well as low credit risk will be involved here. Then corporate bond funds schemes are there. High rated corporate debts are chosen here for the purpose of investing the money of the investor. So these are the different types of debt mutual fund who guarantee you a stable and regular amount of income. Now the next category is hybrid fund. These are having some balanced objectives. So you can say it is a mixture of both the growth oriented and income oriented mutual fund schemes. So they will offer you both the growth and income over a period of time by investing your money. So here a combination of equity instruments and debt instruments are chosen for the purpose of investing your money. Risk level is moderate and investors who are seeking both the objective, that means a balanced return is required by them, and with lower volatility they can invest their money into the balanced or hybrid funds. Here you can find out some subcategories such as aggressive hybrid funds, conservative hybrid funds and dynamic asset allocation fund. So here the ratios are selected for the purpose of investment, that only one debt or only one equity instrument will be chosen, such as in case of aggressive hybrid fund more equities will be selected and less debt securities will be selected. Then in the conservative fund the more debt instruments will be selected, whereas in the dynamic asset allocation fund there will be adjustable equity and debt mix based on the market condition. So these are the hybrid fund. Now there are some other schemes of the mutual funds that are available into the market for the investment. Those may not be included into the growth, hybrid or income oriented fund. So that has been explained into some different categorization as other types of the mutual fund schemes, and that are equity linked saving schemes. So these equity linked saving schemes basically serve the purpose of tax saving of an investor. So if you want to save your taxes, you want to minimize your tax burden in any financial year, then these type of ELSS schemes may be a suitable option for you. So here the objectives of investment is to claim the tax deduction under section 80C plus capital appreciation of your invested money. So they primarily invest into the equity investments. There is a lock-in period of minimum 3 years in case of the ELSS scheme. Risk level is higher as compared to the debt instrument, where it is lower when it is compared to the growth oriented schemes of the mutual fund, and it is suitable for all the investors who are looking for the tax benefit as well as they aim for the long term growth of their wealth. Next scheme of the mutual fund is known as the fund of fund, and as the name is suggests, this mutual fund scheme invest your money into some other mutual fund instead of directly investing your money into the stocks, bonds or other security. So you can assume the FOF funds like a basket of mutual fund rather than a basket of different kind of financial instruments such as equities, bonds, gold, real estate or money market instrument. That means whenever you invest your money into the FOF fund, your money goes into a portfolio of multiple mutual fund schemes, and the underlying funds may be the equity fund, that is the growth fund, debt fund, that is the income fund, then gold ETFs may be there, international funds may be there and multi-asset funds may be there. So here a fund manager basically selects and manages the combination of these mutual funds to create a diversified investment investment strategies for you. So this kind of the fund may be having some definite objectives of investment, such as number one is the diversification. So the exposure to different kind of mutual fund scheme will reduce the risk associated with the investment, as well as it will also offer you a suitable and regular return from your investment. So risk is diversified by investing into multiple other kind of mutual fund schemes. After that, the next objective of investment in FOF is the expert management. So the FOF manager very carefully selects and monitors the top performing mutual fund schemes in the market, and they invest their money into those mutual fund schemes. So they have guidance as well as, you can say, support of the top FOF managers of the market. After that, international exposure may be the next objective of the FOF. So some FOFs allows the Indian investors to invest into some other countries, such as in US, European or other global markets indirectly. So without having a huge amount of risk, you can also invest your money into the international capital market. The advantages of the FOF funds are, these are having a high diversification. So exposure to different fund categories and asset classes are available to you. It is based on the simplified investing. That means you don't need to pick individual funds for yourself. Your mutual fund scheme manager will choose the funds for you. It will give you an access to the international FOF funds also, and professional rebalancing will be available in case of the FOF funds. So managers will adjust the portfolios periodically on the basis of their knowledge and experience. There may be some disadvantages of the FOFs also, such as there may be some double expense ratio. You need to pay the fee both for the FOF and the underlying funds under this category of the mutual fund scheme. Tax inefficiencies are there. Even they are equity oriented, FOF funds returns are taxed like the debt fund in India. So in case if you have a tax saving objective, then it may not be beneficial for you. Complexities are also involved here, so it may be harder to track the performance due to the multiple underlying funds in case of the FOF funds. Now the popular FOF funds in India, as we can see here, are given in this particular slide, where you can see the type of the fund is international in case of the Motilal Oswal Nasdaq 100 fund. Then there are some other funds are also that are domestic, such as ICICI Prudential Asset Allocator FOF fund. So different type of fund on the basis of selection of the mutual fund schemes are available in case of the FOF in India. Now let us understand the next concept that is somehow associated with the mutual fund schemes also. These are known as the systematic investment plan. It is basically way to invest your money into mutual fund that is especially suited to all those categories of the investors who are having a very small amount of savings with them. So SIP basically allows an investor to invest their money into monthly installments or equal amount of money in the mutual fund instead of investing the lump sum amount into the mutual fund schemes. So this particular investment plan helps you by allowing you to save regularly with a smaller amount of money while benefiting from the long term advantage. So SIPs basically gives you some specific features with the help of which you can invest your small amount of saving into the mutual fund scheme, such as you can choose any date for your SIPs. Suppose that if you receive your salary on the 15th of every month, then you can choose the 15 to 20, any date you can choose for the auto deduction of the amount from your salary into the mutual fund scheme investment. So you can choose any date from the month for the purpose of deducting the amount of investment into your SIP. You can stop your SIP anytime in this systematic investment plan. If you are not having a regular source of earning, then you can stop your SIP anytime. You can also redeem your SIP anytime. You whatever income, return and principal amount, that is the wealth you are having, you can redeem it at any time. You can also increase or decrease the SIP's amount anytime depending on your earning capacity, and there is no restriction of amount. You can choose any amount. Even a small amount of 500 rupees can also be invested into SIP with the help of this systematic investment plan. You can stop your SIP and let your investment grow. Suppose that if you do not have a stable source of earning with you and you have previously invested into the SIP for 2 years, then now you can stop the contribution and you can let your money grow into the SIP plan. So with the help of the compounding, your benefit will be going to increase in the SIP. So money required for starting the SIP may be a very small amount of money that will also help the small investor to participate into the securities market, whereas investment instrument for SIPs may be of different types such as equity fund, debt fund, hybrid fund, index fund, ETFs. Different kind of mutual fund schemes focus on different financial instruments for providing diversification to their investors who are having a small amount of money with them. So how the SIP work? You need to choose first a mutual fund scheme depending on your financial goal, your risk bearing capacity and your objectives related with the investment time horizon. Then you need to decide the amount of SIP. Suppose that how much amount of money you want to invest. If it is 500, 2000 or 10,000, you can decide it. Then you need to set the frequency, how frequently you want to invest. That means even you can start at monthly contribution, quarterly contribution, or you can divide it on a 6-month contribution basis. Automated deductions are done from your bank account. So whenever you want to contribute, you can decide a date and you can inform the bank. You can fulfill all the procedures related with that, and the auto deduction will be done from your account and it will be invested into the mutual fund at the prevailing net asset value. Then units are allocated on the basis of the availability of those particular current NAV basis mutual funds. Then you need to track the performance. That means over the time you can track the growth of your investment and you can adjust the amount of contribution into your SIP. Now what is NAV? We have talked about the NAV. So what does it mean? NAV basically is the value of investment after deducting the liabilities from its assets. So the per share NAV is calculated by dividing the NAV by the number of shares outstanding. So here we can see the formula of NAV. For understanding the actual worth of your investment, you can implement the values into this formula. That means NAV equals to asset minus liability divided by total number of outstanding share if you want to ascertain the NAV per share. Now systematic investment plan, how it is better from the lump sum investment, you can see in this particular slide that we have done a comparative analysis why it is better for you to invest into the mutual fund with the help of SIP as compared to the lump sum investment. So basically you may have the following benefits. The first one is small invested money is required into the SIP, whereas in lump sum investment you need to invest large amount of money that may be difficult for the lower income group. Risk and opportunities are SIPs are lower as compared to the lump sum investment. Lump sum investment generally involves higher risk as well as they also offer you the higher potential of the opportunities. Then SIPs are basically a disciplined investment. So here regularly, constantly the contributions are made by the investor. That is why it creates a discipline among the savers of the money to invest their money into the financial market. The various types of SIPs in case of the mutual funds are fixed SIPs, flexible SIPs, top-up SIPs and perpetual SIP. Depending on your objective, you can choose any one of the SIP for the purpose of fulfilling your financial objective. As the name suggests, fixed SIP is the type of investment where every month you need to contribute equal amount of investment regularly into your SIP, whereas in flexible SIP the amount may adjust depending on the NAV of your investment. The top-up SIP give the investor an option to increase their SIP amount in future when the NAV is higher, whereas a perpetual SIP does not have any fixed end date. So it allows the investor to invest until they want to decide to stop investing. So these are the various types of SIPs. Now let us understand the various advantages of SIPs. So it increases the disciplined investment by the small amount of savers of money. It starts with a small amount of money, so you need not to arrange a huge amount of funds for the investment in case of SIPs. It gives you the power of compounding. So in the wealth accumulation objective, it helps you with the power of compounding. There is no need to monitor the market as your investment is taken care of by the professional manager, and the investment is also diversified into multiple financial instruments that are available in the market. So you can say by having all these benefits, the advantage of the SIP is great for the personal financial management of an individual investor. You can have regular investment habits. Markets ups and downs are averaged out with the help of SIP. You can start with a lower amount of ₹100 also. Ideals for the goals such as retirement and buying a home and for your child's education, and it is more effective if you start it earlier because it gives you the power of compounding. So whether the SIPs are taxable? So yes, if you redeem your SIPs before a year, you need to pay a tax of 15% on your gains, whereas if it is a long term investment, this return is taxed at the rate of 20%, giving you the indexation benefit. So if you sell out your mutual fund scheme after 3 years of time, then if you redeem it, then you will be taxed on the basis of 20% after indexing the total benefit out of the mutual fund schemes. So with this, we have discussed each and every aspect related with the mutual fund as well as the SIPs. Now I hope that you all must be knowing that how you can invest your small amount of saving into the SIPs plan, and you can let your money grow, and you can very easily have some constant as well as higher amount of return from your investment. With this, we come to an end of this lecture. Thank you.